Well, welcome to Dairy Livestream. I'm your host, Corey Geiger, managing editor of Hoard's Dairyman. We are broadcasting from our Cheese Cave, our studio in downtown Fort Atkinson at the historic W.D. Hoard and Sons Company building, commissioned by Wisconsin's 16th governor, W.D. Hoard, who also founded Hoard's Dairyman. Our conversation today will focus on where will interest rates take dairy. I'm so pleased to have four great business minds on this episode of Dairy Livestream to share their insights on this very important conversation. As a reminder to everyone in our audience, this webcast will be available on our Hoard's Dairyman YouTube channel 24 hours after the live event. Dairy Livestream is also available anywhere you'd like to listen to podcasts, including Apple Podcasts, Spotify, and Google Podcasts. Search for Dairy Livestream from the convenience of your smartphone to download it. As you hear from our panelists, please submit your questions into the GoToWebinar control panel. The earlier you ask a question, the more likely it will get asked on the air. Let's get rolling with the conversation. Where will inflation and interest rates take dairy? Before hearing from Tanner Ehmke, let's go to our first poll question. In June, inflation climbed to the highest level since November 1981. What was the inflation rate? So our options are 1.1, 3.1, 5.1, 7.1, or 9.1% inflation. So we'll give our audience a little bit of time. We're rapidly voting today. I appreciate that. We'll give everybody about 5 more seconds to answer that poll question before we give you the correct answer. So let's go ahead and cut the poll off. And our audience said 70% of you said 9.1%. That indeed is the correct answer. Inflation is one of the reasons interest rates climbed by 0.75 basis points, the largest monthly upward movement in 28 years. The inflation rate at 9.1% represents a comparison between June of 2021, last June, and June of 2022. We welcome CoBank's Tanner Ehmke to Dairy Livestream. Tanner has a long and deep understanding of agricultural markets. After earning a master's in agribusiness from Kansas State, Tanner began his career as a reporter for Dow Jones and was a contributor both to the Wall Street Journal and Barron's. Throughout the years, Tanner has held several experiences throughout agriculture, and these days he is the lead economist for dairy and specialty crops with CoBank. Tanner, let's delve into how inflation and interest rates are impacting dairy producers, dairy processors, and consumers.
Thanks, Corey. Obviously, a very timely question right now that's on everyone's minds with inflation, as you just mentioned, at 9.1%, the highest in 41 years, and the Federal Reserve trying to play catch up. They've realized that inflation is not transitory, it is not temporary. It is indeed systemic throughout the economy, and so the fear now amongst Jay Powell and the Fed is that they're behind the 8 ball, and they got a long ways to go to catch up. And their most recent guidance is that we're going to be at perhaps 3.5% Fed funds rate by the end of the year, which would be raising interest rates by 200 basis points, not a small amount. So obviously, a concern here with inflation and interest rates rising so quickly is that the Fed may make a misstep and tip the U.S. economy into recession, and that may impact consumption habits. That may impact the consumer's ability or willingness to buy dairy products. They are already trading down from branded products down to private label, or shrinking the size of their purchases rather than buying, for instance, a full gallon of milk. They're buying a half gallon of milk. So we're already seeing these inflationary pressures now. So now the question is, what's going to be happening going forward if they do indeed continue raising rates this aggressively? And the obvious initial impact would be on borrowing costs for dairy farmers and dairy processors. It's going to become more costly to borrow. However, I would stress, though, you got to do the math on the nominal interest rate versus what is the real interest rate. And a lot of that gets lost in the conversation. And the real interest rate is the nominal interest rate, which is what you're paying your bank, minus inflation. So, for instance, I'll just throw a number out. If you're paying 6% on your operating line of credit and inflation is 9%, the market is paying you 3% to borrow money. So even with this these rate increases from the Fed, because inflation has been rising so fast, there is still that incentive to borrow. Now, obviously, we've been watching what the USDA has been reporting in their monthly milk reports, and the size of the dairy herd in the U.S. is only increasing incrementally, only by 2,000 head in the last report. So there's a whole lot of other things going on there, as you've covered quite regularly on the dairy live stream here, Corey, and we've got high feed costs, labor costs, material costs, et cetera, that are impacting that. So as the Fed increases interest rates, it's going to start closing that gap with inflation. So if we start to see the inflation numbers tick down and the interest rate numbers come up, then we're going to see a penalty there for borrowing. So perhaps what we'll see then is another disincentive to expand. As for the processor, another major cost here is their cost of carrying inventory. The cost of carry is going to go up as borrowing costs go up, and so there would be a disincentive there for processors to carry excess inventory. They don't want to buy excessive milk or buy excess milk, and they don't want to be carrying that extra cost in terms of working capital, which would increase their working capital needs. And so what they may do there is reduce inventory, and that may show up in tighter stocks for dairy products in the U.S. We'll see that going forward. That's something we got to watch in the cold storage reports going forward to start to see if rising interest rates does have a material impact on what dairy processors want to carry in their warehouse. And then at the same time, you got to talk about what the consumer is going to do. If the consumer is going to be slowing down their purchases, that would have the opposite effect, perhaps, on what is stored in inventory, because the consumer may not be so aggressive in buying much of anything these days with costs so high. So the consumer is going to be motivated to control cost and slow purchases. That may include trading down to some other cheaper alternatives. So a lot of things there that are kind of pushing and pulling against each other. There's no clear answer, I would stress, Corey, on what interest rates could do, on inventories and cold storage, on the incentive to borrow. Are farmers and processors looking at just the nominal cost to borrow, or are they looking at the real cost to borrow? There's a whole lot of things there that complicate this situation, but rest assured, we are probably going to see the Fed continuing a very strong path forward on raising interest rates, and that is going to be raising the cost of borrowing, in addition to a lot of other rising costs, feed costs, labor costs, material costs, and now you will be managing higher borrowing costs as well.
Thank you, Tanner. And we'll look forward to having you back when we have questions in the second half of the webcast. As a reminder to the audience, you can ask questions to Tanner and any of the panelists as they come to mind. Go ahead and type them into the GoToWebinar control panel, and we'll get them answered in the second half of the webcast. Before hearing from our next guest, Nate Donnay, let's go to another poll question. In June, U.S. housing starts fell 2% and marked how many straight months of decline? 1, 2, 3, or 4? So go ahead and answer that poll question here. And obviously, the housing market has been red cherry hot. House prices are at record highs, and if you're selling a home, that's a great situation. If you're trying to buy one, not so bueno. So we'll go ahead and give people a couple more seconds to answer that question here. And this is a recent development, really. And so let's go ahead and cut the poll question off. The correct answer is 2 months. So 2 months is the correct answer. Residential construction in the US slowed for the second straight month in June as both housing starts and the number of building permits issued declined for 2 straight months, and that's according to today's edition of the Wall Street Journal. Prior to the release of this information, a survey by Wall Street Journal with a group of economists, they had predicted the number would actually rise 1.4%. So what happened here is it dropped to -2. So that drop took place as interest rates climbed and the global housing boom has begun to show a little bit of fade. Could this be a sign that we're headed into a recession? To answer that question, we'll turn to Nate Donnay. Nate has a master's degree in applied economics and has been working in the dairy space for 17 years. These days, Nate is director of dairy insight for the StoneX group. And Nate's been a monthly contributor to Hoard's Dairyman Intel here for a couple of years now, and we value his contributions. Nate, commodity prices, including grains and dairy, have been selling at historical highs. If we were to enter a recession, what might happen to commodity markets near term and long term?
Thanks, Corey. You know, there's a lot of depressing numbers around prices and inflation, and I was digging into the CPI numbers, and I came across the fact that funeral services, the cost of funeral services are only up 2.9% from last year. The cost of living is up 9%, but the good news is the cost of dying is only up 2.9%. What I want to talk about today is a little bit of a tangent from the overall inflation discussion. What we're watching, what the market has been focused on the last 4 weeks, 5 weeks, has been that recession risk. As Tanner said, as you said, Corey, the central banks have noticed that inflation has got out of hand, and it's their job to do something about it. But they have a very limited toolbox, and the tools are pretty blunt. They're going to raise interest rates to slow down investment, to slow down consumption, and that will cause people to buy less goods. So we will have less demand for stuff, and the price increases will slow. Now, historically, they've had a very hard time bringing down inflation from 7, 8, 9% levels without pushing the economy into recession. So you look at it from a historical perspective, and it seems likely that we slip into recession at some point here. Now, the National Bureau of Economic Research is the ones who date the start and end of recessions. And they look at a number of different variables. They look at real GDP growth, employment, industrial production, retail sales, and a whole host of other things. Although the one that gets the most press is the real GDP numbers. Typically, the start of a recession is marked by 2 consecutive months or quarters of declining real GDP. We know real GDP was down 1.6% in the first quarter, and the Atlanta Federal Reserve Bank has a model that tries to tie all these different monthly and weekly macroeconomic indicators back to GDP for the current quarter. And their estimate for second quarter GDP is also down 1.6%. So it's very possible that we already have 2 quarters of declining real GDP. Now, there's some mixed indicators out there that would suggest that maybe we're not in recession. But as Tanner said, if we are looking at recession, and even if it's not recession, central banks globally are intentionally trying to slow their economies to slow inflation. And so even if we don't tip into inflation or into recession, we are looking at slower economic growth, which is typically not great for demand. So we're likely looking at a slowdown in dairy demand driven by a slower economy. And if not by a slower economy, then by less purchasing power as inflation is running above wage growth. And we've seen the commodity markets adjust to this over the last 4 weeks, with crude oil dropping from 120 to 100, with corn dropping from 750 to less than 6, with dairy prices, with cheese dropping from $2.20 to $2 a pound. So we've already seen some downward movement in prices. Now, when we look at commodity prices during recessions historically, during the first half of the recession, we don't always see downward pressure on commodity prices. I think it takes some time for the weaker economic conditions to impact wages and for consumers to change their purchasing behavior. It's really in the second half of recessions that we tend to see the big downward pressure on commodity prices. So when we think about what might happen with commodity prices here around a slowing economy, determining the impact really depends on when you think the recession started. If you think it started back in April, it probably suggests commodity prices could take a dive September, October, but maybe we haven't slipped into recession yet. And the other complicating factor for the dairy market, as Tanner said, the increase in the herd has been relatively small. Milk production in Europe is still down. In previous recessions, in the 2008-2009 recession, milk production at the start of it was growing. And back in the 2001 recession, milk production was growing. This time around, the supply situation is weaker than at the start of previous recessions. So while we may see some negative impacts on demand, maybe the impact on prices will be less than what we've seen in previous recessions.
Thank you, Nate. And you know what, going through this whole scenario is a little bit challenging with inflation because we have most people would say we're coming out of a major global health pandemic. So we have pent up spending power from consumers, but then we have that going on, and then we had Russian invasion of the Ukraine. So you're trying to pull apart some of these effects, and it's a bit of a challenge. I don't know if either you or Tanner want to talk a little bit about that before we turn to Skip. I mean, how do you go about doing that as an economist? Like these things are interlocked, but they're different forces, and you know, for example, the reason this comes up, of course, is when Russia invaded Ukraine, grain markets shot up because could wheat, for example, be delivered? Could sunflower oil and those kind of things?
Yeah, go ahead, Nate.
I'll let you take it if you want.
I was just going to offer the view on just agricultural commodities in general are tight around the world. They were tight coming into the invasion of Ukraine. And when you look at the stocks use ratios of some of these other commodities like grains and oil seeds, it was already a tight situation. The milk supply or milk production was also tight, as we all know. I think Ukraine and Russia was just one more insult to injury there in an already stressed environment. So when you look at the correction we've seen here recently across the commodity landscape, on prices, dairy or milk prices, grain, even metals and energy prices, that move just isn't supported by the fundamentals. I don't think that it was fundamentally led. When you look at like, for instance, the CFTC's commitments of traders report, it appears as though it was a speculative move by money managers. So how do you account for all of this volatility when you've got all this money sloshing around in the global economy, speculators moving money? It's hard. It's trying to pinpoint what's going to happen next is never easy. But I would say, given the tightness that we have globally, the bullish story just doesn't go away, I don't think.
Thank you. We'll remind our audience we got questions coming in here, and if you have a question, use the GoToWebinar control panel to ask that, and we'll get more of those answered in the second half of the webcast. Before hearing from Skip Hardie, let's go to another poll question. In June, gasoline climbed 11.2% over May, so that's month over month. What percent was gasoline up over June of 2021? So that's year over year. 20, 30, 40, 50, or 60%? Anyone who fills up is their trucks or cars are gonna go pretty good on this answer. Go ahead and give people a chance to answer that. And then we'll turn over. So let's go ahead and cut that poll question off. And the correct answer is gasoline prices climbed 60% when compared to the same time last year. Gasoline and other fuel are just some of the inputs eating away at farm budgets. We welcome longtime dairyman Skip Hardie to DairyLivestream, hailing from Groton, New York. Skip is a partner at Walnut Ridge Dairy and Hardie Farms and has a great deal of perspective as a dairy farmer with nearly five decades of practical experience. Skip is a director for Farm Credit East, and he also has a deep understanding of dairy product markets as he served as secretary for Dairy Management Inc. Board of Directors, and Dairy Management Inc., or DMI, is the nation's dairy checkoff. Skip, inflation and interest rates are both top of mind for you every day on the farm. What are your thoughts on this topic?
Well, first of all, Corey, thank you very much for inviting me. It's truly an honor, especially to be with the other three people that really do know what they're talking about. You know, asking a farmer to comment on economics that are really pretty weighty is dangerous. So so I'm going to give you a dairyman's perspective, which is, I know what you wanted. So in our farm, we went through financial hell for the last 6+ years, as I'm sure a lot of your listeners did. It was really ugly. We just kept getting leaner and meaner, and we've kind of come into this period of really great prices, best prices ever, probably, that most of us will see. Not necessarily ready to let's blow the top off this thing and let's go, but rather let's make sure we retrench and understand that this is an opportunity to set the farm up for the long term down the road. So we built a rotary parlor in 2014, which was it's a terrific parlor. I just hate paying for it. It has the capacity for more animals to go through it. We could build a barn. We've been pricing a barn. $4,500 a free stall is kind of the going rate in this area. It just seems like at this point in time, it's a good time to just kind of back off. In fact, I'm going to quote my wife, which I probably should have told her I'm going to do, but if you pick up the pennies, the dollars will take care of themselves. And I think that that's kind of the attitude that the farmers I talk to, we're all in a semi-expansion mood, but we're not in a let's blow the barn doors off and double or triple production. I think that the international market bodes really well for U.S. dairy. The EU and their sustainability question, New Zealand and their, the fact that it's an island. U.S. dairy, I think, is in a good spot if we play our cards right to actually increase U.S. dairy exports substantially, which is domestic consumption, whether it goes down somewhat because of this recession that I'm pretty sure we're in, I think, any increase in production is going to have to be taken off the market, so to speak, by exports. Back home, lean and mean, we strive to be as efficient as possible in every aspect. We installed a robot for post dipping on the rotary parlor, and it freed up 2.5 people. We're at almost, we're not quite there, can't brag, but we're close to 2 million pounds of milk sold per employee. Those are the kinds of things that, year in, year out, you do the right thing, and you weather the storm, whether it's the recession or whether it's just, this tremendous inflation that it seems to be happening. Capital purchases, we've up until recently, we have really not done any substantial capital purchases in the last 6 years. We did just make a major purchase, but it was one of those that if we didn't do it, there would be a very large potential for poor quality forage. We bought a self-propelled chopper, which probably costs more than most people's houses. So I think that's about all I've got. It's very interesting listening to the other true economists, which obviously I'm not. Oh, I meant to mention I have you were mentioning what other people had gotten their degrees in. I have a BA in social science, and then I have a rare MBS, which is management by shovel. So with that, I'll turn it back over to you, Corey, and really, I thank you very much for having me here.
I appreciate that good humor and truth on the management by shovel. And you know what? Sometimes that's the most important degree. I want to, one audience member asked, is that $4,500 per head or per stall in your barn? That quote you got.
Per stall.
It was interesting last night. My wife and I sold our home and we moved our Angus recipient herd to a new location, and we replicated the headlocks and the concrete pad and the fencing and the waters. And I just was entering that in last night into my accounting system. And we built a setup like that in 2012. And I wrote the check out yesterday, and it was nearly double for the same thing. Same design and everything else. That's just 10 years different here. So those are some of the price inflations that we're seeing. And so we'll go to a next poll question here right before we hear from Andy Novakovic. In April, general purpose credit cards and loans rose by what percent? 19, 29, 39, or 49. So go ahead and answer that poll question here. It'll speak to what's happening in the consumer market here in the United States. So we'll give everybody a little chance to answer that question. And again, we got some questions coming in for our panel. You can go ahead and ask those in our GoToWebinar control panel, and we will answer those in the second half of the webcast. So let's go ahead and hear what our audience think to this question. And the audience said 29%. However, those of you who answered 39%, you got it right. Americans are borrowing again at levels not seen in more than a decade. Consumer demand for auto loans and leases, general purpose credit cards, and personal loans were up 39% in April when compared to the same time last year. So that's year over year. And that's according to Equifax. We welcome Cornell's Andy Novakovic back to Dairy Livestream. Andy, this borrowing demand is one of the reasons inflation keeps climbing. If inflation stays around for some time, how will this situation impact producers, processors, and consumers?
Well, you know, one of the things that I wanted to start out with is to remind us all that we talk about groups like producers or consumers, and we need to continuously remember that there's just an awful lot of variety within each of those groups. I would say 10 to 15% of American households, based on household income, are basically not affected by inflation. I mean, they've got some balance sheet issues, no doubt, but in terms of being able to go to the store and buy whatever they want, whenever they want it, it's not really a big deal. For some folks on the other end of the spectrum, it's gigantic. It's whether or not you can continue to live in your house, or you're going to have to move out onto the street or under a bridge, literally. And we need to be mindful of that. As Tanner mentioned, we're aware that consumers are already employing various tactics to deal with inflation. That comes in several forms. One is how much you choose to buy. One is what you choose to buy. As is typical in inflationary periods, but in particularly when we dip into recession, durable goods suffer. This is not a time when the other 85% are going to be looking to buy a car unless they just absolutely, their car just died in the driveway, and washing machines and those sorts of things. On the other hand, there's stuff you can't really do without. Food and transportation would be two pretty obvious examples. Housing expenses, whether it's rent or utilities or care for your own home. And so those expenditures tend to be more consistent despite the stress, but it crowds out the ability to do other things. Indeed, when you look at the data that's available most recently, consumer spending for last May shows a huge decline in the purchase of motor vehicles and other automotive parts, 53%. But the categories that are on the upside relative to a year ago are housing and utilities, gas and other energy goods, healthcare, and food and beverages comes in on that list, but at a far lower rate. Housing, healthcare, we're talking about being up 15 to 20%. This is expenditures now, remind you. Food and beverages are at 8%. So people buy what they need. And part of what we're seeing in terms of these expenditures isn't that they're buying more of what they need, it's just that it's costing more. One of the points I wanted to make in here also is we focus on food because that's the industry that we're in, but food inflation relative to some other things looks, what should I say, less bad. And in some ways, I think food continues to have a bit of a silver lining relative to other things. We're not in danger of not being able to feed ourselves. And so the real question is going to be how well we're able to support families who have serious income problems. I also kind of wanted to take a little bit look at the data to see what do we know about income relative to expenditures and that sort of thing. If we look again at the most recent data, which of course is not up to this exact July minute, we see that actually a number called personal income, which measures income to families, family-owned businesses, and that sort of thing, continues to be up at about the same level it's been up through most of 2022. We're starting to see a decline in outlays. In other words, this is the spending out of that income. So people are being reserved. And I think as we get more data, we'll see that pattern of behavior continue. What are the sources of this ongoing increase in personal income? The biggest one is earnings, wages and salaries from labor. A variable called proprietor's income is up. That's primarily from people that own their own businesses. These data don't include farms. We shouldn't assume that farms are doing worse, but we typically exclude farms from those kind of data. But a number that's declined is social benefits for low-income individuals. We don't have the big payouts that we had during the pandemic. Medicare and Medicaid have increased because they've got some inflation adjusters built into them, Social Security. But there are a lot of folks on the low end of the spectrum that are struggling. And, you know, these include elderly who have retired and kind of thought they had done enough work. This includes people who are disabled. This includes people for whom it's really challenging to get a job because they have childcare. Maybe they don't have a spouse or a mother or father that can assist with that. So, you know, there's just a lot of folks in a tough situation. And I think a real challenge for us is to figuring out how we get through all of that for that whole profile. And I won't go into it, but of course, you could tell a similar story about America's farmers or dairy farmers in particular, that not everybody is cut from the same cloth. The last thing I wanted to throw out was a little bit of conversation on what's driving this, and if we know what's driving it, what can we do about it? And I'm really, really mindful. You know, the rear window on the Economist automobile is like crystal clear. We got really pretty good idea where we've been. The front window, not so much. And a lot of sort of debate about what is that up there? That looks like a moose. No, that's not a moose. There's a gopher though that's running over there. And so doing diagnosis and doing prescription is a tough job for us. Even though we know the theories, it's not so easy to always to sort it out. In my opinion, and you look at the data, energy is the single biggest category that's pushing up prices. And of course, it doesn't just push up the price of gasoline, it pushes up the price of everything that uses energy, which is like pretty much basically everything. And so one question I would ask is, how exactly is higher interest rates going to help us push down energy costs? And I kind of struggle with figuring out how the heck that's supposed to work. It's also a question, is this systemic or is this episodic? Is this about Russia fiddling around and disrupting the supply of petroleum products? And when they stop fiddling around, it all goes back to good. My feeling is it's not really systemic, but if the war stopped tomorrow, all the pieces wouldn't go back quite into place either. Labor. To me, that's very systemic. People have said, I'm not willing to provide as much labor for as much as you used to pay me. I want more income, I want more benefits, and I don't see that changing one iota. That's built in, which leads to Skip and his partners looking around to see whether or not somebody else can take care of teeth dip. And how does all that play out? You can't go into a McDonald's without being able to push 15 buttons before you can get a cup of coffee. How does all that play out? So getting a better grip on what's driving inflation and then what you can do about it is one of our challenges. And I think sometimes we end up with 1 foot smashing down on the accelerator and 1 foot smashing down on the brake and wondering which one's going to win. And clearly interest rates are smashing down on the brake, but I'm not sure if we've really figured out what's going on with the accelerator. But with that, I'll yield my remaining time to the chairman and look forward to your questions.
Thank you. We've had some really good one-liners in this Dairy live stream. We got a lot of questions rolling in here. We're going to go straight to them. This one's a little long, but people will quickly get the gist, and maybe Tanner or Nate want to tackle this one first. From a milk price risk, let me start over. From a milk price risk management perspective, how can you protect against inflationary effects on milk markets? From the looks of the DMC and dairy margin coverage decision tool, margins will become more challenged in the second half of the year with continued high feed price and potentially falling milk prices. DMC is not projected to trigger indemnities, but add in other input costs to feed, and many dairies are probably in a negative margin position even with $20 milk. So that's the setup question there. We'll put it back in a nutshell here. Second half of the year, milk futures are dropping, but feed inputs could still be high. What's a dairy farmer supposed to do? Tanner, Nate?
It sounds like a risk management question for Nate.
All right, since you took the other one, I'll take this one. I have been asked a lot in the last year about how inflation factors into my dairy models, and at least in the US, it doesn't. From a long-term perspective, the inflation-adjusted milk price has been declining for decades, right? The main question, what matters is that margin, and the question touched on it. How do you protect that margin? And it's the margin that's important. You have milk futures to protect the revenue side, and you have feed futures to protect those input costs. The other costs, while they have increased from a long-term perspective, they tend to be more stable, and there isn't a whole lot that you can do to protect your labor cost other than investing in more equipment and more robots, right? So you have to take some risk. You can't protect all of your input costs, and you can't protect all of your revenue either. But at this point, protecting some of the milk revenue and some of the feed cost is, I think, prudent. And I don't know, at $20 milk, you might be locking in a break even or a little bit lower margin. So it may take a little bit of patience to wait for the market to bounce a little bit to lock in that positive margin. But the opportunities have been there over the past 6 months to get some coverage on at what looks like profitable margins for most dairy producers.
Thank you, Nate. And part of that, and you're right, we saw some better futures prices here in June, for example, on the milk side. Some strategies too, dairy revenue protection, or on the CME, is taking bites of the apple when you're profitable, and sell some but not all, and there's different strategies to employ along the way. We got quite a few questions coming in here, so we're going to go to another one here. Andy Novakovic, I think I'm going to toss this one to you first, and then we'll see if Tanner or Skip maybe want to chime in, or Nate, of course, too. How much, if any, credit does our panelists want to give to dairy co-ops in their supply control programs to the current farm price of milk? So obviously there's some different, and it varies by region of the country, but there are some, you can only ship so much milk. And his question really that audience member is asking is, has that helped milk prices? Andy?
Well, of course, we don't have public data on how much milk farmers would have produced if they hadn't had these programs. So you have to kind of have a little intuition and a little guessing going on. But I'm going to go with, I think they made a difference. Although I'm living in the state of Wisconsin now, my career was spent in New York, not just a little bit down the road from Skip. And I pay a lot of attention to what's going on in New York. I don't think there's another part of the country that has employed these methods as aggressively as they've been employed in New York. And just from talking to the folks I know, Skip is shaking his head up and down. They made a difference, enough so that people feel like it's constrained their ability to do things that they think they really need to do, should have done. So I think it's part of it. It certainly doesn't explain $28 milk across the country, but I think it's been a part of what's been going on.
Skip?
I agree 100% with Andy. We're fortunate enough to ship to a smaller co-op that has not placed any limits on our production. But in the Northeast, it's pretty uncommon to ship milk someplace where there isn't a cap on your production. And so it can't help but increase or decrease supply somewhat, some way.
Tanner or Nate, anything to add on that one? If not, let's go to the next question here. And I think, Tanner, we're going to send this one to you. The opening question, or poll question this audience member is referring to, said inflation at 9.1%. So the comment here is, while that is a historically high number, I do wonder if it is actually understated. Are we really at 9.1%, or is it higher when using historical calculations? Any comments? So this audience member is suggesting essentially that inflation is even higher than that 9%. What are you seeing, or maybe talk about the trends that could be coming down over the horizon here?
Well, I think the consensus out there with a lot of economists is that the number is going to be coming down in the second half of the year, and the recent drop in commodity prices is going to flow through into retail prices over the next quarter. And so on that note, we're probably going to be coming down. Now, historically, I think the question was, 9.1%, the highest in 41 years. How does that compare perhaps to the consumer's ability to withstand it? Perhaps that might, let me put it another way. Let's say, for instance, gas prices record high. However, the economy is different. Let me use this as an example. Although gas prices are record high, we don't use as much gas per household as we used to. We have more efficient cars, for instance, and then at the same time, we're a more efficient economy, so there's less gas prices. To what Andy, I think, was talking about earlier. Fuel prices are baked into everything because everything is transported to a grocery store shelf, right? And so there's efficiencies within the economy that have been made over time, and so the impact of a higher gas price is not going to be as blunt as it used to be, like we saw perhaps in the 1970s and early 80s. I don't know if that answers the question, but I would say because this is a different economy with different technologies and transportation habits have changed, people aren't driving to the offices, their office or to work as much. Those things have an impact. So I don't know if that was answering the question, but I would say that the 9.1% inflation number is going to be different because the economy is different and our lifestyles are different and our technologies are different. So
Andy,
it's not the same for every household.
thank you, Tanner. Andy, what are your thoughts?
One thing I'd say is there are several different measures of inflation, and they all make a certain amount of sense. The consumer price index is the one we hear about because it's actually a number that is calculated. No, I shouldn't say frequently, but it's you don't have to wait too long to get that number, and so it's current, so to speak. There are some folks that say, well, you should really look at the composition of what people buy. And if that changes over time, then, maybe I'm not buying buggy whips anymore. So what happened to the price of buggy whips doesn't really matter. I should look at what I have. Buggy whips is, of course, hyperbolic, but that the change of what I purchase should be included in the overall sense of cost. And there are techniques for doing that. A number that a lot of macroeconomists prefer to use over the CPI is called the personal consumption index. And if you look at that number, it's running at around 6%, a little over 6% right now, year over year. The point is, as long as you're comparing the same number regularly, you're going to get an indication of, are we experiencing inflation, deflation, or stable? And all the indicators are saying we're seeing inflation. And I would recommend not getting overly fixated on the exact specific level.
Thank you, Andy. We're going to stay with you on this next question here. It just came in as the conversation was taking place, comes from a dairy farmer on the West Coast. Is the producer price index, PPI, much higher than the consumer price index, CPI? So,
really good question. I don't know, Nate or Tanner, do you follow that more closely? Because I don't have the current data embedded in my head.
I don't have the latest PPI number in front of me. I haven't looked at it yet.
So while Tanner's pulling that up, which isn't so hard, one thing that I would say is keep in mind that when you're talking about retail price inflation, you're talking about cheese that sells for $3, $4, $5 a pound. When you're talking about wholesale price inflation, you're talking about cheese that sells for $2 a pound. When you're talking about farm level stuff, you're talking about milk that might represent $1.70, $1.80 out of that $2 wholesale price of cheese. One of the things I like to remind folks is if there's a 10% increase at the farm level, you shouldn't expect 10% all the way along, because 10% of 180 is not the same as 10% of 5. And if there's a 20-cent bump in the 180 and a 20-cent bump in the 5, where you'd say all that cost is exactly passed through penny for penny, the percentage increase at the consumer level is going to be a heck of a lot less than the percentage increase at the farm level. So we need to be a little bit careful about expecting to see the same numbers all the way along, or assuming that if it's higher at the consumer level than it is at the processor level, that somehow there's something shaky going on, because there's you got to take into account the absolutes versus the percentages, and there are lags. Looking at 1 month doesn't tell you a story. You got to look at several months. So, Tanner, you got the number now?
Yeah, the PPI number was 140, but I'm trying to get the year over year. It's taking me a minute here. My computer's bandwidth is a little slow here. Sorry, guys.
Well, why don't you go on, Corey, and we'll see if we can pull that up while you're going.
So actually, then we talked about this a little bit in dress rehearsal yesterday when Chris Wolf was with us. This comes in from an ag lender. As an ag lender, I see organic farmers struggling as milk prices are relatively flat and expenses have experienced inflation. And just as a side note on that, relatively flat, many organic co-ops or processors will state a price at the beginning of the year and hold true to that. So continuing on, we're struggling to consider long-term viability of these operations as we find very limited data to consider long-range price forecasts for organic milk. What are your thoughts as a lender or an analyst on the organic milk market and really the economic part of it? Nate, do you have it? You want to start with that one?
Sure. We don't have a whole lot of data on the organic market on an ongoing basis, so it's a little bit difficult to analyze. I was talking with a large retailer that their product mix is biased towards organic and all natural and those types of products. And some of the people there are hoping that with the increase in conventional dairy prices, we've narrowed some of that gap to organic, and we may get people jumping from conventional to organic, which we did see back in 2008. But my fear is with economic growth likely slowing down, that households are not going to be, you look at a $1 difference per gallon of milk, they're not going to make that jump up to organic. So I think there are some headwinds to consumption growth on the organic side. I guess the other issue that they're facing is historically it's been around fluid milk, right? And that part of the market is getting a bit saturated. So the marginal growth for organic, I think, is in the products, the cheese and the butter, and the value of the milk going into those products is typically lower than what you're going to get for the milk going into the bottle. So I think there's some overall pressure on the total return, the total milk price that can be paid as more organic milk moves into the ingredient side of things instead of just the bottled side. So I think there are some headwinds towards the total returns for organic milk, and recently the spread between organic and conventional.
Okay. We're going to go to speed round here because we have a flood of questions coming in. Before I do that, Tanner, were you able to locate that information on PPI? If not, we'll go on.
Yeah, I focused on commodities and it was 11.2, it looks like. And so it's faster than CPI.
Yep. And Corey, I just sent Caitlin the graph. If she can pull that up and put it on that extra screen, that might be interesting. But it kind of makes a point. We're seeing more at the wholesale level because it's a percentage on a smaller base.
So we're going to go to speed round here. The first question is, and it relates, we're going to send this one back to Tanner. It came in from a longtime viewer here, and I was able to interpret it. I'm going to read the question just as it came in, and then I'm going to do a little interpretation. Tanner, how far above the inflation does the Fed have to go to cool inflation? So I think this reader or audience member was talking when you were talking about the nominal rate that markets are actually paying you to borrow money, that 6 versus 9% example. So I think that's what he was asking about, like how much more do inflation rates have to, or excuse me, interest rates have to go up to cool the economy if we are indeed paying people to borrow money?
There's a lot of debate on that, on if the Fed has the ability to do that. I mean, they would need to raise interest rates to 9.1%, up from where we're at 1.5. That would be pretty hard. I don't think there's anybody out there who thinks that that's possible. And so that raises the question of what is the true measure of inflation then? Because a lot of the inflation we're seeing out there is not so much demand driven, but supply driven, with supply chain issues, with labor issues. Raising interest rates isn't necessarily going to cool demand off sufficiently to bring inflation down to the Fed's targeted level of 2%. I mean, that's a pretty far ways to fall from 9.1. So I think that raises another question. Like I said, how do we want to measure inflation? Is a 2% target even realistic these days? Maybe it should be something more along the lines of 4% or 5%. That's a whole can of worms that the Fed does not want to go into. They'd have to change a lot of policy. They'd have to change their idea of why they're there. It's the dual mandate of controlled prices and stable stable prices and stable employment.
Okay.
So that it's a complicated way of looking at it, but I don't think there's somebody who thinks they're going to race it that far.
Corey, I just want to throw in, to me, this question is very much like, if I keep mashing my foot on the accelerator, how much harder do I have to push on the brake? If this thing is being driven firstly, not entirely, but firstly by energy, I'm still struggling to figure out why punishing people with interest rates, why preventing Skip from making investments, why preventing businesses from making investments is going to make that scenario better.
We're going to put that slide up on the screen, Andy, and give you about 30 seconds to talk about that. So Caitlin's going to put that on screen like it's a poll question, and go ahead.
The blue line is higher than the green line. Bingo.
And the blue line is producer price index, and CPI is consumer price index. Tanner, anything to add on that?
I think that's I think that tells the story right there. So over time, those are going to have to come back into an alignment, and so you're going to see some curtailment there, probably on investing, because of that rise. The course PPI is going so high so fast past CPI.
Yeah, there's a correlation. The blue line bounces around more. There's more variability in the producer price index and the consumer price index. There's a lag. PPI comes down. The green line comes down a little bit later. We could expect those same patterns going forward.
I'm going to toss this question up for anyone here because I'm not quite sure who to direct it to. It's with fluid milk, specifically whole milk, saw price increase more significantly than the monthly CPI, Consumer Price Index. What has been the driving force behind this? Can the inelasticity of fluid milk withstand this escalated price?
That was a catch-up. For quite a few months, retail prices for beverage milk were lagging. And this is very typical of retailer behavior. Retailers, despite what some of you might think, are not overly keen to increase the price on a food item that they think is a traffic builder for their store. But when they do, they do. And I think that's what we're seeing, is this is saying, okay, this is for real, I can't avoid it. I'm going to make a big jump, and hopefully I can live on that big jump for a while.
Here's another toss-up with 3 minutes left in the program. Isn't milk demand still relatively inelastic? This person gives a $3.50 gallon store for milk, cow's milk store brand, versus oat milk at $5.50. So isn't milk still rather inelastic? Any comments?
Well, actually, there's plenty of academic research. No, there's not plenty. There is some academic research that would confirm that. Probably the most thorough and ongoing is the work that a guy by the name of Oral Capps at Texas A&M does for Skip's buddies in the promotion program. And his elasticity estimates continue to confirm that dairy is not overly responsive or particularly responsive to price. That does not mean that it's nobody cares. So we can see switching effects. We can, as I think Tanner mentioned, people going to private label as opposed to branded, and maybe not buying quite as much. Oddly enough, what some people do when they don't have a lot of money is they buy a quart instead of a gallon because they can't afford to pay the price for a gallon, even though per unit it's cheaper. Yes, inelastic, but that doesn't mean it's not, totally insensitive to price by any stretch.
Tanner, you had something on that?
Yeah, I agree. It's one of those basic core items, along with bread, along with rice. Not a lot of people are going to be wanting to divert away from those basic calories. It's still an affordable protein, affordable fat when compared to the other animal proteins, for instance. So I think it's going to be hard for people to deviate away from that. I think it's actually because of that value comparison and compared to other animal proteins, it's going to be attractive. So I think to the other point of people trading down, I think people are doing other behaviors. They're just buying smaller quantities and perhaps more frequently, so it just doesn't seem like they're spending as much every time they go to the grocery store.
One more toss up here. What is going to have a larger impact in the Federal Reserve short-term tightening, or which would be quantitative tightening when they reduce their balance sheets, or the current position and stance on interest rates? Anybody want to grab that one from a longtime economist who listens?
Well, in monetary policy terms, you're talking about the supply of money versus interest rates, which are sort of related, but not exactly. And it's a little bit difficult to answer that question until you kind of quantify how much interest rate, how much tightening of the money supply. I think what the Fed is showing us is that right now they're pushing the interest rate lever more so. But Tanner, what are your thoughts?
I think they're going to be really leaning heavily on interest rates to control inflation, and the money supply issue. I think when I take a step back, it's that's ultimately the main driver here. Inflation is too many dollars chasing too few assets, and so they're going to be forced to tackle that problem. And so the irony is that when our interest rates go up, that attracts demand for dollars, and so it's going to be driving up the value of the dollar, and that has a whole bunch of other extenuating impacts.
Skip, the final question is going to be you. In New York State, people are asking about labor, and one of the big things here is inflation is being driven up by higher labor rates. How are you looking at labor saving devices versus labor on your farm?
So the first thing we did actually was go and speak with all our employees when the overtime law was passed, and most of them all of them were really very understanding about it, and quite frankly really didn't agree with the law, but that was neither here nor there. We've managed by managing their hours. They help us manage their hours. When there's overtime to be paid, then we pay it. It hasn't been the burden that we thought it was going to be. The burden's coming as the state of New York ratchets down the number of hours they can work before overtime starts. So it's labor efficiency is one of the big ones that we on the farm can deal with, and we're doing what we can do at this point in time.
Thank you, Skip. Our next dairy live stream will air on Wednesday, August 17th at 11 a.m. Central Time, and will be archived on the Hoard's Dairyman YouTube and podcast channels the very next day, just like this episode. On behalf of Tanner Ehmke, Nate Donnay, Skip Hardie, and Andy Novakovic, I'm your host, Corey Geiger. Thank you for joining us today. We wish you all a good day. Goodbye, everyone.